Well, hello there, everyone. Welcome to another edition of Tip Tuesday. This is Geoffrey Nance here with you. Last week we talked about stopping out. We actually went into a broker or two and actually talked about that. We looked in the chart setup and saw what that looked like. And today we're going to talk about another way that we can automate this system and perhaps make it a little bit easier for us to navigate. So let's just say you feel like, man, one of the reasons I have for not feeling like I can trade or maybe trade as often as I would like is I can't really sit there and watch it. So my job doesn't allow that. Well, we talked about the stop out last week, and that's an important function that you need to have. And it's a tool that you need to have in your belt available and ready to use on any trade that you ever enter, because that's a real possibility that you would have to stop out. The other side of that coin is the ability to set an order to sell at a certain price or higher. And in essence, what this means is I could buy a stock, I could buy an option, I could do the same thing with a credit spread or a debit spread. I can set orders at particular profit targets. Now, remember, if I buy anything, it could be a house, a car, a phone, piece of dirt. If I'm going to make a profit, I have to sell it at a higher price. So obviously, that's going to be my goal. If I enter a trade, buying to open, then I want to make a profit on that by selling at a higher price than my initial purchase price. So the thing that we're able to do from an automated order perspective is to go in and set an order to sell at a limit price. Now, a limit is exactly what it sounds like. It says to the market makers, which is who you're dealing with, they're the ones trying to make these transactions take place for you. The market makers, their job is to create a market so that you can buy and sell stocks and options. So that's their job. And so we're dealing with them. And we're able, through our broker, who is basically creating the go-between here for us to be able to trade and get in and out of these positions when we want to enter and when we want to exit. We're able to go and send an order to these market makers. And a limit order, let's just say we're buying first. So we go in there and we say, I'm going to buy. Well, you put in a limit order. When you're entering an order to buy, you're basically saying this is the limit. Another word for limit is maximum that I'm willing to pay to enter this trade. So market maker, if you're willing to give me this stock or option, credit spread, debit spread, whatever, at this price or lower, I want in the trade. Put me in the trade. I want in that trade, but this is the limit. That number I put in there, that's the limit I'm willing to pay to get into this trade. So you got to give me that price or better. Now they have the opportunity to be like, nah, we're not interested. We don't want to give it to you at that price. And in that case, you either have to raise your limit or you just kind of walk away and say, well, that's okay. I tried and I didn't want to pay higher. You guys didn't want to give it to me for lower. It's a little bit like being at a garage sale. It depends on how badly they want to get rid of that thing that's in their garage at that time. You say, I'm willing to pay this price. They say, well, I'd really rather you pay that price. And then either you guys come to a conclusion where you compromise there and you say, okay, we'll give it to you for that price. And so you're able to get in that trade, or they hold firm and say, nah, we're not selling it for anything less than that. And you say, well, I'm not willing to pay anything more than this. And then you just kind of walk away and the deal never takes place. Well, that's what happens when we buy. But what about when we go to sell? How does a limit order to sell work? Well, now what we do when we say this is the limit now applies to the minimum that I'm willing to take. Okay, so it's the minimum that I'm willing to take. So market maker, if this stock, option, credit spread, debit spread, whatever, hits this price or a higher price, the limit, the minimum that I'm willing to take to get out of this trade is X, and you enter that dollar amount. So if the stock moves up and it triggers your limit price and they're able to fill that order, then you could be doing whatever it is that you're doing. I mean, you could be asleep and it could trigger that order, execute that order, and you'd be like, wow, look at that. I made money on a trade and I didn't even I didn't do anything. I just set an order and then let it do its thing, and the stock did what I thought it was going to do. And wow, look at that. Same thing with an option. Also applies to credit spreads and debit spreads. So a limit order is basically you saying, all right, if the price reaches this or higher, go ahead and sell me out. You don't have to be in front of your computer for that to happen. There are two types of orders as far as when it comes to time. We can do a day order, or we can do a good till canceled order. Now, a day order does one of two things. It either executes, feels that day. So in other words, they do what you wanted them to do that day, or it gets canceled at the end of that day. So if you do a day order and nothing happens that day, then you're still in that trade. And then you got to say, okay, so the next day I'm going to come and I'm going to put a new order in. If you do what's called a good till canceled, one of two things happens. That order stays there. It's an active order until one of two things happens. It actually gets executed, so the order gets filled, so the transaction takes place, or you go in there and you cancel that order. So that's a good till canceled order. So when it comes to deciding, what do I want to do? Do I want to have an automated order? What we have to do is we have to keep in mind that an automated order is basically going to execute, but only when the criteria are met. The other thing that would be involved here is understanding that in order for a limit order, okay, to execute, we would have to probably have the understanding that I may be willing to make a little bit less than I could have if I did not set an automated order. So in other words, if I was sitting there watching it, I might could get a better price, but I'm not sitting there watching it. So I'm doing the automated order because I'm busy, or I don't want the stock or the option or the spread to get to a place and then for me to have missed the opportunity to sell at that price. So again, I may be giving up a little bit of money here just for the ease of being able to, enter and exit an order, particularly in this case, exit an order at a certain price, but I may be willing to take a little bit less than I could if I was sitting there watching it live. So one of the things that you also need to be aware of is that most brokers may not allow you to set both a stop loss and a limit order to sell. So if that's the case, then you may have to decide which one to me is a bigger deal. Which one to me is more important? Would I rather have a stop loss? So in other words, if the trade starts to really go against me, I want to make sure I get out of that trade and I don't lose any more money than I was okay with when I entered the trade. Or do I want to say, you know what? I want to have a target price. And if it reaches that target price, I really want to sell there. Which one is more important? If they have the potential for you to do an OCO, which stands for one cancels the other, if they have that as an option, what you can do is you can actually go in and do both. You could set a stop order. So if the trade goes the opposite way of what you intended and you're losing money, you can stop losing money. You can set the stop loss like we talked about last week. And you could also set your target price. So if it reaches my target price, I could do that. And the order would be there for both of those. And then that would be an order, let's just say you made that good till cancel, that would be active until one of those two things occurs. So either you got stopped out or it hit your target price or moved above that, and therefore it became an automated order that just executed without you having to do anything further. So those are the types of orders. Those are the setups that we're looking at. I thought we would spend a little time now just kind of going in here and looking as to what that might look like, just as far as the execution. Again, pretty simple setup here. It's not going to be too different from what you did with your stop outs like we talked about last week. So let me go ahead and just flip over here. Now, this is just a weekly. It's on Walmart. It doesn't really matter for what we're doing. Well, let's just say I went out here and I bought this 109. So I was in this trade. And so what I want you to do is kind of focus over here. So assuming we were in this trade, and now it would show up under my positions. I'd be able to go to my positions, click on positions, and then I could click this. So this is what I would do. I would be able to go in there and select, all right, market limit, stop market, or stop limit. So those are the options I have. Now, obviously, if I do a market order, then it sells at or below that price. So let's just say that we did buy this for, we'll just say we bought it for 105, the bid price. Now, they wouldn't give us that price, but let's just say we got in and we did get that price. Now, if I come over here and I say, you know what, I want to do a market price, right? And I clicked on that. Notice it takes the price away. Like, what happened there? Now, it doesn't really matter whether I do time and forces day or GTC, because the reality is I just told the market makers, hey, give me the price you want me to take because I'm ready to get out of this trade. Okay, so we don't really want to do that as far as, hey, I'm trying to set an automated order. So that would be more for if we're trying to enter or we're trying to exit and we're watching it. So this would be more of something that we would do if we were trying to get in or out very quickly. Then we have stop market and stop limit. Now, we talked about both of those last week, so let's talk about the limit order here. Now, you'll notice I click on limit order, and as I go from here, now what I would do is I would come in here and set a price. Now, obviously, this again, remember guys, we would go under our positions page once we were already in a position. So you'd have to be in the position first. Once we entered that position, then we could go over here, click under positions, and then instead of it being green for buy, it would actually be an S. It'd be for sell. So sell. And then we would go over here and we would just set a price. So you say, well, what was a good price for me to be able to sell this thing for? You say, I bought it for $1.05. And you know what? If it goes up to $2.05, I'd be fine with that. Now, again, it's a limit order, and I'm basically saying to them, if the price gets to $2.05 or higher, I want you to sell me out of this trade. Again, time and force, I would have to decide, do I want this to be a day order where I could kind of switch it from one day to the next, or do I want to make it GTC? So let's go ahead and make that a GTC, which again is good till canceled. I could review and send, and then that order would be sitting there. Now, remember, I'm not going to be charged a commission for this entry I just made, unless this trade is actually executed or filled. Now, if the trade is actually filled or executed and they do sell me out at 205 or higher. Now, notice let's just say it got to like 206 by 222. Well, is 206 by 222 higher than 205? It is. So more than likely, if this was the case and my option had moved from $1.05 to 206 by 222, they're probably not going to give me like 215, 220, right? They're probably going to give me 206. But again, 206 meets my criteria. I said, look, if it gets to 205 or higher, go ahead and sell me out. So most likely, I'm probably going to get 205. Just remember, they won't be able to give me less than 205 because that was my criteria. It has to be 205 or greater. And again, you could make that a limit order GTC. Notice here that I can't have both the stop loss and the limit order, so I would have to decide on which one of those I wanted. So we talked about the stops last week, talked about limit orders this week, and that gives you guys an opportunity to kind of see, well, what does it look like to place automated orders on my trading, and is that something that maybe I should consider doing to allow myself to really be able to take advantage of movements without sitting in front of my computer screen. And I think for some of you, using automated orders, particularly if you feel confident about the direction that the stock is going to move and how that's going to impact either your stock purchase or your option or spread purchase, that would allow you to be able to do some things without feeling like you have to be glued to your computer and watching the stock's movement each time. Well, that's our Tip Tuesday. Appreciate you guys joining us today, and we will see you guys next time.